Conversions to C Corp. Here are some reasons to consider looking at a C Corp. Are you investing in your business? Because if you're investing in your business, as I said before, would you rather invest 60-cent dollars or would you rather invest 75-cent dollars? Now, and in this discussion, I'm going to say, I've had many discussions, there are playoffs of basis issues with S Corps versus C Corps. There are some, if you end up doing an asset sale in a C Corp, it's more expensive, but let's talk about this. You need investment. What happens if you already have incurred significant debt? Wouldn't it be better to pay that off with cheaper tax dollars? I had one client that was an architect, and during the crash, he put $1 million into his business as a loan. If he took it back out as an S Corp, he's paying double tax on it because the repayment of his loan is not a deductible expense. We converted him to a C Corp, and he paid back that $1 million using a lot cheaper tax dollars. Supplemental retirement, we talked about non-qualified deferred comp plans. And again, the idea here is if you take the money individually and you invest it, you're investing 60-cent dollars. If you do a non-qualified deferred comp plan, you're investing 75-cent dollars. You're creating an asset on the books, which is going to add value to the business, and you're using the cheaper tax dollars to do it. Talked about classes of equity for C Corps versus S Corps. As I said, they're not, what's your tax bracket? Because I've always look at this analysis, because if you're only in the 30% tax bracket because of the income you're taking out, this is not going to make sense. But if you're in 37 plus Medicare taxes plus and your state taxes, then you're starting to talk about some real significant savings. Again, C Corp is better for gifting purposes because you can put it into a trust, you can retain the income in the trust. And lastly, as I mentioned, if you have an ESOP, if you're sold to an ESOP, C Corporation defers your tax liability. This is a very abbreviated example of the tax savings on $200,000 and a 5.75 tax rate. And I would say most people would rather accumulate 137 of the 200 rather than only 114. So this gives you an idea of how the numbers would shake out. As I said, every deal is different because if you're only in the 30% tax bracket, then this is not going to be much savings. But if you're in the 37 or greater and you're in a state that has high state income taxes, the C Corp looks a lot better. Other things to look at with that regard, those of you who have S Corps, you get that little state, you have to include your health insurance on your tax returns. If you become an employee of a C Corp, that's gone. You can do the medical reimbursement plans. S Corps restrict what owners can take out. C Corps do not. So you can be covered by a medical reimbursement plan as an owner in a C Corp, but not in an S Corp. May not be as important for you, but it may be, is that if you're a C Corp, you can have a year end other than 12/31. In retail, it's perfect because really they should be, January 31 is really their great date because they have to take in all the returns after Christmas. The idea, depending on how you're structured and whether you have heavy years or not, having something other than 12/31 also allows you to play a little bit with your income because you're going to report as of December 31st, what your W-2 is. Therefore, if you had a January 31 year end, you could pay your bonus in the next year and defer the taxes for a year. So you can roll that. Another problem with S Corps is that you have is, as you may be aware, you report your pro rata share of the income of the company on your tax return, right? And therefore the company's got to give you enough cash to pay the taxes, right? What investors and what employees are going to necessarily want to own stock in an S Corp where they could have income and you don't pay them the taxes? So, also, C Corps will have less audit risks, which means you can probably be a little more aggressive with regard to family benefits, family payroll. It's less likely you're going to have a problem with a C Corp versus an S. Disadvantages. Double tax is cited as the big one. Double tax says that you pay taxes on the corporate money, and if you then take it out as a dividend, you're going to pay 15% on it. Well, two things about that. First is if 21 plus 15 is 36. Current federal tax rate is 37. Okay? Second issue is that you guys should be able to relatively know by December 1 what your profit looks like for the year. And if not, you should fire your CPA and find a new one. Okay? The point is that what you do is you say, okay, I'm going to buy this framing machine. I'm going to need 100K. So what you then do is you say, okay, I need to report $125,000 worth of profit. 25 goes to pay Uncle Sam, 100's in the company. The rest, you declare a bonus to the employee. What does that cost you? It's only cost you the 2.9 Medicare versus the distribution. But you've gained the flexibility of accumulating that $100,000 that would have taken you $140,000 if you'd taken it as an S distribution versus the $125 it's costing you. And we'll talk a little bit about year-end tax planning. The big concern that I'm going to tell you is if the IRS views you have excess accumulated earnings, they can put a penalty tax on you. I tell clients, and I live by a quote from a movie, you can't get in trouble if you tell the story right. If you're accumulating money, if you say, I got a principal stockholder who's going to be leaving in the next 3 years, and I need to accumulate $1 million. The IRS can't question that. If you say, I'm on an acquisition spree, and I'm going to be acquiring businesses, this is why I need to accumulate the money. So as long as you document in your minutes, etc., why you're accumulating the money and some kind of target figure for it, you should not have a problem with the accumulated earnings tax. Plus, I've been doing this now, as I said, close to 40 years, and I've never had an accumulated earnings tax, an IRS audit on accumulated earnings. It may become more of an issue, and this is the other point I want to make. Everyone says, well, if the Democrats come back in, tax rates are going to go up. I completely agree with that, but what I'm going to tell you is that everyone I've talked to believes that on a pro rata basis, individual rates are going to rise a lot faster and a lot higher than corporate rates. President Obama in his tax bill was 25%. I've heard the worst I've heard so far, someone saying 28%, but those are the same people who are talking about a 50% tax rate on individuals. So, but there is a risk, obviously, on the tax rates. But I'm going to say that I think that the likely scenario is individual rates are going to go up higher and quicker than corporate rates.